No matter what you do with early stage, whether you invest with a fund like us or you invest with an online platform, is it absolutely has to be a portfolio strategy. We can help a company, but we can't necessarily do the work for them. At the end of the day, there needs to be the right people in the right seats to get the work done.
Hi, everyone. My name is Akash Jain. Welcome to my podcast, NextGen WealthCast. Today, I'm very, very excited to invite and talk to my friend David Evans. David, welcome to the show.
Thanks for having me, Akash.
David, I know you and I have been going back and forth over a number of years, and we met a few times. And I know you are very, very astute when it comes to investing in technology and investing in these days. I believe you're investing a lot in AI. What I want to start us off is, why don't you help our viewers understand a little bit of your background and what you guys are doing today?
Sure, happy to. So I got involved with AI long before it was cool. So I got started with working with AI, building predictive models for NASA in the late 90s, trying to determine whether or not there was going to be enough components of the spacesuit for the shuttle flights associated with launching the International Space Station. That kind of carried thematically throughout my career in technology, from building predictive behavioral models to determine whether a sporting event or a concert was going to sell out before it actually sold out, all the way down through creating a conversational commerce engine for live event ticketing. So I've had a long tail experience with artificial intelligence as a practitioner. My background is software and tech. That's what I got started as a coder. And I still write code, still use the tools today on an ongoing basis. So I turned to the investment side after selling my last company about 10 years ago, and was primarily focused on your traditional SaaS investments, what everybody was investing in 10 years ago. But what I noticed in 2018 was all of the tools I had historically built. They were brittle, they required specialized knowledge, they were hard to maintain, and they really only worked for the company that you built it for. So my company or NASA or whomever you built it. What I was starting to notice in 2018, I was a startup investor at the time as an angel, and I was working with a venture fund here in Dallas. What I was starting to notice is companies were finally starting to be able to commercialize technology in a turnkey way, to where it didn't have that brittleness. It didn't have that sort of bespoke nature that AI had for so much time before. So in 2019, I decided that it made sense to build a fund focused exclusively on those opportunities, focused exclusively on companies building AI to solve real business problems and help companies use AI to make money, save money, or improve customer experiences. That's what we did in 2019, and that's still what we focus on today, even though it's gotten much hotter, to be candid, over the course of the last couple of years.
So I believe you're on your second fund. Hey, how you evaluate a company? When do you believe it's ripe for your investment, your dollars, to make a difference in their graph, if you may?
Sure, absolutely. I think, ironically, it's got a lot more difficult, right? When we used to look at companies pre-Chat GPT, we'd have companies self-select out and say, oh, we're not AI focused, we're not AI first. Now, everybody claims to be AI focused and AI first, which is actually one of the challenges of our job, and I think even your listeners' job, is to try to figure out what does that really mean to be AI first and AI focused. It's really sort of threefold, right? One, we look for companies that have an algorithmic moat, a data moat, and have some form of what we call distribution moat, right? So algorithmic moat is they've got some approach to delivering the technology that is proprietary to them, that other people don't have access to and other people can't recreate. If they have a data moat, they have access to data that doesn't exist elsewhere or isn't publicly available for access to competitors. And when we talk about that distribution moat, we talk about, is there a path forward where the product gets stickier and stickier over time, where there's sort of a feedback loop that by interacting and working with the product, it becomes more and more valuable to the companies that are using it and makes it harder and harder to switch away to a competing product. You can theoretically switch to someone else's product, but you don't have the benefit of the data, the usage, and the expertise that happens with working with that company. So those are the three things that we generally look for at the core of what we would call an AI first or AI native company.
Got it. And then what about, I'm assuming, hey, some of the basic table stakes, hey, the team needs to be great and they need to have a clear path to monetization, those kind of things. Those are just table stakes and you are looking at them on a case by case basis.
Oh, absolutely. And I think one of the key things that's getting left out quite a bit is really a company needs to do one of three things. I don't care whether it's AI, whether it's crypto, whether it's quantum, whether it's traditional SaaS. It needs to help somebody make money, save money, or improve a customer experience, right? And that's really where we start the evaluation, is that you need to generate value for your user. And we invest in B2B software. So those are the three main points that companies are going to buy, right? Help me make money, save money, or improve a customer experience. I'll pay for those three things. If you don't do one of those three things, it's not something that somebody really needs. And it makes it much harder to drive adoption of that product. So that's really kind of the table stakes that we look for.
Got it. Interesting conversation here. Help us also understand, hey, how do you, hey, how does somebody look at it from a portfolio perspective? I know a lot of our viewers are investing in the stock market. They also invest in the real estate market, but people kind of tend to shy away from startups, if you may. And maybe, and I know a lot of your investment goes in seed stage startup. That is also even more risky than A, B, or C. Help our viewers also understand, how do you evaluate based on this risk, if you may, hey, early stage versus late stage, and how should they be thinking about this?
Absolutely. So interestingly, one of our venture partners wrote a paper on the correlation between real estate and venture. And I'll let you consume the paper and happy to share it with you later. But fundamentally, what he found in his research is that venture capital is actually the most inversely correlated with real estate, which sort of makes sense, right? With venture capital, we're looking for outlier returns, right? We're looking for power law type returns and outlier winners. Versus real estate, you're looking for stable, steady Eddie type returns. So it makes sense from that perspective. But it's a healthy part of an expanded portfolio, partly because it's uncorrelated, but also because of the timing of where we're at in the market. As of the last study I read from Goldman, only about 5% of companies have generated any kind of revenue or products or services from using artificial intelligence. What that really means is that we're at the earliest stages of the investment cycle. You can't go to your Schwab account and buy AI, right? There's a handful of limited companies that you can buy in the public markets: NVIDIA, Microsoft, Amazon, Meta, but it's a small handful. It's very similar to buying into the web in the mid 90s. You could buy Cisco, you could buy some of the infrastructure companies to the web, but you couldn't buy a Salesforce, you couldn't buy an Amazon. We're in that same kind of period of time when it comes to startup investing, of where we're at the next generational opportunity, but most of the opportunity is concentrated at the very earliest parts of the market, right? ChatGPT only launched 3 years ago. I mean, it feels like it's been around forever, but it's only been 3 years. So we've really only started to be able to see the opportunity to build on top of those tools, to build on top of those technologies. So if you're trying to take that risk on portion of your portfolio and gain some exposure to AI, it's really going to be at the earliest stages, right? You can get some infrastructural access to it from sort of big tech, but the real winners, the Salesforces and the Amazons, those are going to come at the earliest stages. They're not even PE ready, right? These are companies that are they're just releasing their products, or they're just getting through the earliest part of the cycle. So in this part of the market, there isn't that mature private equity option, and there isn't a public market option to take advantage of this part of the cycle.
So would you then say that, hey, if somebody wants to diversify their portfolio and really want a little bit of their chips in the AI space, now is the time, or should they wait for it to mature a little? What is your advice to people?
Now is absolutely the time to get into AI, right? Because what we're finally seeing is the smart entrepreneurs, right? The ones that have that vision for the problem that they understand and the market that they understand, and how the technology can affect that market, are just finally coming to market, right? It takes a while to understand how to apply a technology to a market problem. It takes some experimentation. It takes time to build the solutions for those markets. So we're just starting to see those entrepreneurs come online. They're starting to deliver those solutions. You may have heard the term thin wrapper, right? There was lots of those types of companies that really weren't building products. They were just creating a user interface to ChatGPT, for example. Those companies have finally fallen by the wayside. And what we're seeing is the entrepreneurs are coming to market with products that rethink the way we solve problems in the era of AI. So now is absolutely the time to invest in them. And it's going to be a short window, right? The rate of change in this market is such that the window of time isn't as short as many people would tell you, but that window of time is about 3 to 5 years to be able to get in at the earliest, biggest opportunities, right? Any natural market cycle, you go through an S curve. This market will start to mature in the next 3 to 5 years, and you'll start to see public market opportunities. But along with that, the multiples will be much smaller. Right? You won't see the 100x opportunities the same way you will at this particular time.
So, from that perspective, then, should they be taking a portfolio approach and investing in a fund like yours, where they're investing in a handful of companies? Or do you see them going to Equity Zen or the likes, or do some angel investing with one or two companies that somebody that they know of?
So no matter what you do with early stage, whether you invest with a fund like us or you invest with an online platform, is it absolutely has to be a portfolio strategy. Generally speaking, you cannot start to realize a return in early stage investing unless you have a minimum of 10 investments. All of the historical data I've ever seen is that there's sort of an S curve to returns in venture investing, that below 10 investments, you're near guaranteed to lose all your money. And it rapidly starts to improve once you get over 10. Because the problem in venture isn't just in picking winners, it's picking winners that are big enough to make up for the companies that don't make it, right? And so it's what's called a power law business, that you're going to have one company that's going to generate the vast majority of the alpha in your portfolio, which is very, very unlike real estate or private equity. But it has to be a portfolio strategy. So any of your viewers that are considering venture investing, or angel investing, you absolutely need to set out with the notion in mind that you're going to work with a fund that's going to invest in a portfolio of companies, or you will build a portfolio yourself of at least 10 companies before you ever write your first check.
Very cool. Amazing advice there, David. Now, hey, talk to our viewers a little bit about some of your war stories, or where you have seen that 100x, if you may.
So, I think you stumped me a little bit, because war stories generally aren't always positive, right?
Which is great, positive or negative.
I think one of the things that we're seeing, and it's an interesting story from our portfolio, and it's one of our biggest winners at the moment, is a company that kind of had to forage in the wilderness for a while, and figure out what it means to be AI first and what it means to deliver value kind of in a new paradigm, right? So it's a company called TestRigger. And what they do is they automate application testing through natural language. So you can test software using natural language rather than having to write code. And, it's taken them a while to figure out their positioning in the marketplace, right? Because there's a lot of fear right now about, AI is going to take jobs and AI is going to take away my job. So it took them a while to sort out their positioning, because as much as they're a valuable product and they deliver lots of value, they can help save money, they improve product quality, but the people you're selling to have a fundamental belief that, well, wait a minute, you're taking away my job. In reality, that wasn't the case. What the case was is that in application testing, you generally would get what's called 30% test coverage, right? Meaning about 1/3 of the application is completely covered with automated testing. We all know that because we've all interacted with really bad software, right? With TestRigger, with no incremental staffing and no loss of staffing, you're able to go from that 30% test coverage to 80 to 90% test coverage, right? Nobody's losing their job. It's just we're getting a better quality product. But it's taken a while to get to the point of where they're able to communicate that effectively, number one. And number two, where the market is willing to sort of accept that as kind of the ground truth, right? It wasn't always the case of where they were the breakout winner. Like they kind of went sideways for a while, because they have to kind of work through partly timing of the market, right? Of where the market needs to be ready to adopt, but also just in how they position. So it's kind of my mix of war story and success story, kind of all combined into one.
That's brilliant. And I believe, I'm sure you or your partners had some hand in bringing them back to the path of success. How did you guys participate in their success?
So ironically, that was part of the whole process, right? Was when we went in, we knew that they were kind of stuck in neutral and really needed to help them get through that hump and get through that plateau and accelerate. Otherwise, we wouldn't have invested. So give a ton of credit to my partner, John, who worked really closely with the CEO, helped them identify the sort of bottlenecks in their process, the bottlenecks in the way they were describing and messaging around the product. And then probably most importantly, help them in their recruitment of their current VP of sales. We can help a company, but we can't necessarily do the work for them, right? At the end of the day, there needs to be the right people in the right seats to get the work done. So John was able to help them work through the process of finding a head of sales that was able to implement the right messaging strategy, implement the right sales strategy and right go-to-market motion to kind of break out of that plateau. And now they're completely off to the races.
Very cool. So, David, also for our viewers, right? Hey, so I know you're very passionate about technology, and but let our viewers know, who is David? What is your why? I know you live in DFW area. Talk to them about, hey, what are your other passions, maybe off of work?
I mean, candidly, I don't know if I have much time for other passions because I've got two kids that I run all over the Metroplex to soccer and baseball. Maybe that would be my answer is ultimately my kids. It is really the story of my life outside of work as of late, which it's actually been kind of nice having been a founder. One of the things that happens in venture capital is, we need to drive success in the portfolio, right? So I can't go deep with any individual company. It's like I had said before, is that, we can help them, but at the end of the day, I can't go deep on one individual company because we need to work with all 17 portfolio companies and we need to help work with them. So it's actually been kind of this forcing function as an entrepreneur of where I'm used to going deep. It sort of forced me to be able to balance my time across sort of all of my children, 17 portfolio companies plus the two biological children that are running around the house here this afternoon.
Very cool. But what about, hey, maybe a karaoke song that they make you sing, or the breakfast on a Father's Day or whatever that you guys prepare together? Talk to us a little bit about that.
So I still haven't found the exact provenance of the song. But there's a song that my kids and I have been singing since we saw it on social media, which is I think the title of the song is "I Was Right," and it's basically about how Dad's always right, and you should just listen to what Dad says. Like that's
I tell my kids all the time.
I haven't been able to find the exact song, but my kids and I sing it, especially when I am right.
Now, both my boys, hey, after stumbling and after going through a lot of trouble, they'll come back and say after 2 months or whatever, Dad, you were right. I'm like, hey, I told you so, man. But no, this is a lot of fun. Hey, David, also, now I believe you yourself have a diversified portfolio. Talk to us about, hey, yes, you invest in startups. What else do you do in your portfolio?
Yeah, sure. So outside of Sentiero, we went through my wife and I went through kind of the standard problem that most exited entrepreneurs have after a liquidity event. Right? As we spent almost 15 years of our life with all of our net worth tied up in our businesses, and we had a liquidity event that now kind of unlocked that liquidity, which is a strange place to be in. You go from being fundamentally broke to having capital to deploy. So we've got capital deployed in direct owned real estate. It took us about 4 years to get fully redeployed, quite candidly. We've got capital in direct owned real estate. We've got some multifamily real estate that we're part of. We do a lot of syndicated multifamily real estate. We do some private credit. We do some private equity, direct investments. We try to maintain a diversified overall stance. But candidly, we tend to partner with other folks. Like at the end of the day, one of the things that we've realized is, when it comes to operating companies and early stage investment, that's probably, the place for me to manage that money. But we generally find partners when it comes to multifamily real estate. And candidly, it's the same ethos as venture capital, right? I look at 1,000 deals a year as a VC. I don't have the time to look at sort of a similar scope and scale when it comes to operating companies and buyouts and private credit opportunities. We generally tend to find professionals that do it all day, every day, and see sort of a similar top of funnel that we do at Sentiero.
Very well said, David. Again, a diversified portfolio and letting and partnering with other individuals who are experts in their own field. I couldn't have said that better. Absolutely, David. It has. What about hey, you with your crystal ball? What do you see happening in the next 3 to 5 years? Where should everybody be looking at? I know probably your answer is AI, but let's zone in on it a little. And then, what parting advice would you have for our investors?
Sure. I mean, over the next 3 to 5 years, I think is really the commercialization phase, where we're going to see the broad scale adoption of AI, but not in the sort of outlandish AGI ways, right? Like the narrative you hear from Sam Altman at OpenAI and Dario Modi from Anthropic is that, AI is going to take over everything. And, Elon Musk and the Optimus robot from Tesla is going to take away all human labor. That's really sort of, candidly, it's overpromising. And it's hyperbole to justify super high valuations. The reality is that we're going to see AI permeate our lives in the same way that mobile has. Now, we don't do everything on mobile, right? Like we still go to e-commerce websites. We still have laptops. I remember a point in time early in the cycle of mobile where people said, nobody's ever going to buy a laptop ever again. Like you're just going to do everything on your phone. I'm sitting on a laptop. You're sitting on a laptop, right? But it's hard for us to foresee how it's going to change, but it's going to be as ubiquitous as mobile. It's going to be sort of this omnipresent part of our lifestyle in the same way as mobile. And that's the way AI is going to be. The other thing that's going to happen towards the tail end of that timeline, because of the demand for compute power over that time period, on the tail end of that 5-year window, we're really going to see the uptake of quantum and of quantum computing, because we don't have the electrical infrastructure and we don't have the compute infrastructure to be able to serve all of the needs that AI is going to have. And that's going to drive further research, further development, and further adoption of quantum computing. But that's really going to start at the very outer edge of the process. I think that's really kind of what I would say looking in my crystal ball over the next 3 to 5 years. The other piece is, and I'll selfishly say, I think startups tend to be a safe haven in times of uncertainty, especially early stage, because there's a couple of things that startups have as an advantage. Is one, you're generally investing over a longer time horizon. Right? Like I'm not investing for a return over the next 2 to 3 years. I'm investing across economic cycles, which is one of the reasons why it tends to be non-correlated with other assets, is that I'm investing across a longer time period. The other thing we've seen play out even in our portfolio is that when you're a small company, you're less impacted by macro factors, right? So, Amazon gets impacted by tariffs, right? Because there's a direct impact on their business, because it is so big that broader macro trends are going to impact companies like Amazon. Versus we have portfolio companies that operate with Amazon sellers that they've seen some change out in their business, but what's happened is they're so small is that they have the opportunity to pivot who they serve. Right? They're able to even as they lose companies that may be negatively impacted by tariffs, they're picking up companies that now need to get more competitive in the wake of tariffs. And they're small enough of where they're able to swap out different revenue line items versus Amazon. They're so big that they can't be as nimble, and they're going to be more directly impacted by macro conditions. So if you have capital that you can be patient with, I definitely think the earlier stage is going to be a little bit more resilient to any of the kind of uncertainty that we might see over the course of the next couple of years.
Wow. What nuggets, David. Thank you so much. Folks, there you have it from the venture capitalist himself, David Evans from Centaurio Ventures. Guys, we'll post his contact information at the end of this video. But David, such a pleasure having you on the show. Thank you so much. And we'll be looking at Centaurio to pick some winners here. Thanks a lot.
Thanks, Akash. Appreciate
it.
No matter what you do with early stage, whether you invest with a fund like us or you invest with an online platform, it absolutely has to be a portfolio strategy. We can help a company, but we can't necessarily do the work for them. At the end of the day, there needs to be the right people in the right seats to get the work done.